Hello legends, it's Guan here. Good to see all of you here today. The good old Fed is now planning to raise interest rates by tapering. And here we have Omicron Covid variant cases in several countries already. So why is everyone talking about the upcoming market crash? Alright, into the next segment. Fed tapering explained. Okay, we have heard a lot about the quantitative easing program from the Fed, and Fed is now planning to raise interest rates by tapering.
Bro, what fucking you, man? What's with this alien language? You better explain like I'm 5 years old.
Okay, to sum up the Fed quantitative easing program, it's this. No, I mean serious. Take a look at this interview clip with Jerome Powell, the chairman of the Fed.
Simply flooded the system with money.
Yes, we did. That's another way to think about it. We did.
Where does it come from? Do you just print it?
We print it digitally, so we as a central bank, we have the ability to create money.
Okay, so let's contextualize what this really means. So you have the Fed, and the member banks like JP Morgan, Goldman Sachs and others. The member banks sell corporate bonds to the Fed, and the Fed just digitally prints out money to buy the corporate bonds from the banks. Now the banks, they have received the money, and this will lower down the interest rates. With lower interest rates, the bank can now lend out more money to companies, to individuals, and thereby boosting the economy. At least that's theoretically what the Fed is trying to achieve. But the Fed is now planning to taper down the bond buying program. What this means is that the Fed is planning to reduce the bond buying frequency. That means less money flowing to the economy. This would then increase the interest rate, and this is making everyone nervous, as this would mean companies and individuals need to pay higher interest for the loans they take. The side effect is that with the increased interest rate, the bond yield will rise in tandem with the interest rates. So the market investors have two choices now: either a safe bond investment with higher yield, or equity in the riskier small-size hyper-growth companies with low earnings that need to rely on borrowings to fund their operations. Now, you see, investors are always chasing for more yield, and tapering would mean rising interest rates. And this means bond investment with the increasing yield will be worth more than the equity in the small-size hyper-growth companies.
Okay, so the interest rates are expected to rise because Fed is reducing the bond buying frequency. What about the effect of the new Omicron Covid variant?
Alright, into the next segment. Omicron Covid effect. WHO reported that the preliminary evidence shows that there's an increased risk of reinfection with this variant. Okay, not again. Just when we thought 2020 was finally over and 2021 came with the Delta variant. And 2022, Mother Nature just welcomed us with the Omicron variant. But at the moment, we still don't know how much more deadly this variant can be. Scientists still don't know how the current vaccine efficacy against this variant at the time of this recording. It's therefore prudent to think about the potential lockdown scenario and its effects. Now, do you still remember how the stock market reacted in the March 2020 when WHO officially announced COVID-19 as pandemic? Basically, it was very super volatile and everything was red in color. It's only natural for the stock market to react and overreact. Taking Peloton as an example, how much more can it grow in this potential lockdown scenario? Oh, apparently the share price did pretty well in the last lockdown. Anyway, there's no guarantee in the future. One way to think about it is that if the Fed continues to taper and the interest rates rise despite the new variant coming around, small businesses will potentially have a harder time to operate as the cost of borrowing increases, making them look riskier. Another way to think about it is that if the Fed realizes that the new variant is causing a lot of economic damage and decides to delay the tapering, this could potentially help buy more time for the small businesses. You might ask, at this point, what's gonna happen next? Well, before we go, be sure to like, sub, click the bell for more video every Friday. With that said, into the next segment. What will happen next? With so many potential scenarios to play out, how are we going to predict what will happen next? Wait, let me ask my crystal ball first. You know what? My crystal ball isn't working at all. I need to send it back to the Vietnam factory for a refund. Okay, jokes aside, given that all of these potential scenarios could play out, I have only one question to ask myself. Number one, I will ask how much of my stocks will get affected under a potential lockdown scenario. Now that I don't have airline stocks, retailer stocks, and tourism related stocks, but I have pretty much tech heavy stocks instead. So, most of my tech stocks have got quite strong balance sheets to weather through the potential lockdown scenario, and I believe that they can go through this without any issues. I mean, I don't own the Federal Reserve, and I don't own the money printer like Jerome Powell. What else can I do? In fact, people pay too much attention to the broad market index of the S&P 500 index and the over-sensationalized Shiller PE ratio, whereas not looking at the valuations of the stocks in their own watch list. Take a look at MercadoLibre for example. The 52-week all-time high share price was at $2,000 per share, and the current share price is around $1,200 per share. This is a massive 37% drop from all-time high. Coinbase is another example. The 52-week all-time high share price was at $429 per share, and the current share price is around $300 per share. This is a massive 29% drop from the all-time high. These cheap valuations can potentially be a buy if these two businesses are still working and thriving. All in all, focus on the stocks in your own watch list and ignore the broad market index like the S&P 500 index. Broad market index is only telling us the investors' sentiment. With that said, into the next segment. My final thoughts. If you strongly believe in knowing what the investors think of the market can help with your analysis, you can just take a look at the Investor Sentiment Survey. This Investor Sentiment Survey asks what the American investors think of the market in the next 6 months. However, my personal question would be, what would be the benefit of learning about investors' sentiment? And do note that how fast the investors' sentiment can change from 3rd November to 24th November, a huge marginal change. So now you see, investor sentiment can change like a wind from time to time. It doesn't tell you how the companies can prepare themselves in the potential lockdown scenario. Most importantly, avoid asking this question.
When Lambo?
All in all, stick to your own plan, invest safely, and review your own stock portfolio from time to time. And I'll see you in the next one.